Okay, hi again. The next account we're going to do in the revaluation of fixed assets is the provision for depreciation account. So the provision for depreciation account is not, it's like the aggregate depreciation account or the accumulated depreciation account. So it's an account which contains the same figure that you would get in the depreciation column in the balance sheet. So it's more like a liability. In other words, its balance will be on the credit side, and when you're increasing it, you'll put it on the credit side. Not like depreciation, annual depreciation that you put in the profit and loss account. That's an expense, but this is the aggregate depreciation, and that's why it's on the credit side rather than the debit side when you're increasing the amounts. So we'll be starting this one on this side then, on the 1st of the 1st, 07, where we'll have our balance brought down, our opening figure for the account in 2007. Now, where we get that from is this information in here. It says in the 1st of January, they had buildings 360, land 240. Now, important to remember, we don't depreciate land, we only depreciate buildings. The company depreciates its buildings at a rate of 2% per year. And the property has been purchased in 2003 and depreciation has been charged in each of the 4 years up to 2007. So there's already 4 years depreciation. Oops, just get my calculator there. So it's going to be, what do we say, 360,000 multiplied by 2% multiplied by our 4 years, isn't it? Is 28,800. So there's already 28,800 aggregate depreciation. So each year, if I just divide that by 4, each year there was annual depreciation of 7,200, and because 4 years have passed, it's now gone up to 28,800. Okay, so that's the first thing. That's where we start, and then we look at what's happened in 2007. So January 1st, revalued land and buildings. So we know whenever there's a revaluation, that sets your depreciation back to zero. So what we have here on this side, we put anything that lowers the amount of depreciation, the aggregate depreciation, and we put anything that increases the aggregate depreciation on this side. So if we're setting it back to zero, we're lowering it. So 1st of the 1st, 07, it's being lowered because of a revaluation reserve. Again, I'm just saving space and time here, but you should put in the full words. And it's lowering it, if it's setting it back to zero, it's lowering it by 28,800. Okay, so that's the first thing, and that's it. Nothing important then in the rest of that. The thing is, though, that happened, that revaluation happened on the 1st of January, the very start of 2007. So even though we set the depreciation back to zero, the clock starts again immediately from the 1st of January. So by the end of 2007, you will have a year's worth of depreciation built up again. And so that build-up of depreciation, it increases our aggregate depreciation, so it goes on this side. So 31st of the 12th, 07, and that's the amount that will go into the, if there were a trading profit and loss, it would go into the trading profit and loss as an expense. So we give it the title, profit and loss. Profit and loss, and it's a year's depreciation. Now, how do we calculate the depreciation? We saw at the beginning it was that 360,000 by 2%, but now we've revalued the buildings upwards. The land and buildings were 700, but the land part was 270. So if I subtract the 270 from the 700, I get 430, and then it's going to be 430 multiplied by 2% for the year, 8,600. So that's the annual depreciation there, which goes on this side because it's increasing the depreciation in total, the aggregate depreciation. So we add total of the bigger side, which is definitely this side. And that's going to be, what, 4,737,400. So this has to have the same total. And of course, to get the same total, we know it's going to have to be 8,600, isn't it? For that to be the same as that. So we call that 31st of the 12th, 07. Balance carried down. If that's the balance carried down at the end of the year, it's going to be the balance brought down at the start of 08. balance brought down. 8,600. So that's 1 year's depreciation basically built up again since you set it back to zero. So what happens in the next year? You sold land which cost that. Well, that has absolutely no effect on our depreciation account, our provision for depreciation account, so nothing to do there. However, every year, I mean, even if nothing happens, our depreciation is building up, or our assets are going down in value, and our depreciation is going up. So though nothing happened, we still have at the end of the year, 31st of the 12th, 07, profit and loss, our annual depreciation, which is increasing our aggregate depreciation. And we don't need to work it out because we worked it out at the end of last year. The buildings haven't changed. It's another 8,600, and there's nothing on the other side, so we're going to total this side. 8 and 8, 16, so 17,200, and must be the same over here. 17,200, and this must be 31st of the 12th, 07, balance carried down. And if that's the balance at the end of that year, it's the balance at the start of the next year, 09, balance brought down. And what do we say, 17,200. Okay, so next thing is, let's have a look at what happened in 2009. It says, purchase buildings, blah, 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 blah. So all of that doesn't matter in its own right at the start of the year, but it does matter when we're calculating our depreciation, because whereas in the first few years we were calculating 2% of 430,000, now we have way more buildings that we have to depreciate here. They were all of that happened at January 1st, so it means we had an entire year of these buildings to depreciate. So we need to figure out how much was the total cost of our buildings now to get 2% of it. But of course we don't have to figure it out. We can just look back to, remember this is 2009, look back to the end of 2009 here, and our balance carried down was 1,080,000. So all we have to do is take that from our buildings account and get 2% of it. So 1,080,000 multiplied by 2% is 21,600. So 21,600 is going to be my 31st of the 12th, 09. Did I write 07 in that one? That should be 08. Apologies. That's going to be my profit and loss figure. And again, that's definitely going to be the bigger side. So we'll total that. 800, so that has to be the same total over here. And 31st of the 12th, 09, I better get my years right this time. Balance carried down. And what do I need here to bring a total of that? Well, it's got to be the full amount, doesn't it? 38,800. And again, bringing that down to the next year gives me my opening balance. So first of the first 10, balance brought down 38,800, and then we go and see what happened in 2010. Oh, another revaluation. Revalued buildings owned at that amount. And again, it was at the 1st of January. So just like the last time, we first of all have to set that back to zero. And the way we make it zero is make it go down by 38,800. And to make it go down, we put the 38,800 on this side. And that's the 1st of the 1st, 2010. And it's because of a reval reserve that it's going down, or going back to zero. But again, that happened at the start of the year, so there's going to be a whole lot of depreciation building up from that time onwards until the end of the year. And this time, it's going to be 2% of our new cost amount, so 1188. So it's going to be, where are we? 1188,000 multiplied by 2%, 23,760. So 23,760. This is the 31st of the 12th, 10. It's the end of the year, and it's profit and loss. And that's definitely going to be the bigger side, isn't it? So we're going to add up that side, and it's going to be what, 560, 4, that's 1260, 2560. And so we need a 31st of the 12th, 10, oops, balance carried down. And of course it's got to be this, doesn't it, to make that side the same as this side. 23,760. And so that's the balance we're going to have on the 1st of the 1st, 2011. Balance brought down 23,760. Now let's see what, that's a nice zero. There we go. Let's see what happened in 2011. It says, sold for 400,000. Again, not important. The building's owned on the 1st of the 1st, 2007. Okay, so here's the thing. If we have a balance in our accumulated depreciation account here of this amount, that's the depreciation on all the buildings that we own currently. If we get rid of a building, then we can't have anything to do with that building on our accounts anymore. And if some of this is depreciation on the building we got rid of, then we have to take out that amount, whatever it happens to be, whatever portion of this that happens to be. So luckily enough, we just revalued the year before. So there's that here, 23,760 is just 1 year's worth of depreciation, and it's 1 year's on all of our buildings. But we know that the building that we got rid of, we did this when we were doing the land and buildings. When we got rid of it, it had gone up to, in the last revaluation, 473,000. So out of this revalued buildings up to that amount, 473 of that amount is attributed to the buildings we owned at the start. So then when I got 2% of that amount to be the total depreciation for the year, well, that included 2% of this and 2% of the remaining buildings. But it's the 2% of this we're interested in. That's the bit that we want to take out of our books again. So if we work out what that is, 473, multiplied by 2%, 9,460. We know out of this 23,760, 9,460 of it was to do with the buildings that we've now gotten rid of. So we want to take that out. So 1st of the 1st, 11. Is it? No, it's for disposal, excuse me. Disposal. 9,460. Okay, and then sold them, and the remaining buildings were revalued. So what happens when a revaluation occurs? Our aggregate depreciation gets set back to 0. So at the moment, it started at 23,760. It went down by 9,460. So how much further does it have to go down? Well, 23,760. And it went down already by 9,460 because of the disposal. You see, 300, 14,300. So it's got to go down by another 14,300 if we're going to set it, if we're going to be able to set it back to 0. So here we have reval reserve, 14,300, and now if we were to look at it at that point in time, our aggregate depreciation account would be 0. Started at 23,760, went down in total by 23,760. Now again though, all of that happened on the 1st of January 2011, so from that time on the depreciation clock started ticking again, if you like, or depreciation started building up. So we 1 year's depreciation on the remaining buildings, and it's very easy to calculate it because the remaining buildings at that point had been revalued to 950, so we're just getting 2% of 950, 19,000. So 31st of the 12th, 11, profit and loss. Our depreciation account goes back up by 19,000, and now we need to total the bigger side. Which is going to be the bigger side? Well, if that's equal to these two, then this is definitely the bigger side, isn't it? I'm going to bring this down a bit because we're going to have to, if this is a smaller side, we're going to have to squeeze in our balance on this 31st of the 12th, 11 balance, carry down, and well, we know what it's going to be, don't we? It's going to be 19,000, because if that is equal to that, then it needs another 19,000 for both of them to be the same size. So let's see, that's what, 760. What's that, 42,000, I think. So this must be 42,760. And then just the last thing to do, first of the first 12, balance brought down, whatever the balance up here was, 19,000. That's your aggregate depreciation at the start of 2012.